Gina, are we reading too much into this? It's like a couple of percent. I mean, it's major money, $140 billion or something on Friday lost. At the same time, should we be just taking a beat here?
Yeah, maybe we should be taking a beat. I kind of agree with that sentiment. I think Julie actually hit the nail on the head when she talked about the rotation. Because what's really happened here is our investors are rotating a little bit of money back into value in general as a theme, especially led by financials, and out of growth, which has been led by tech. So I think, if you take a broad step backward and you look at how extreme those trades have gotten, value had outperformed growth, by 1,400 basis points in the 6 months ending the end of May. We hadn't seen that level of outperformance since 2010. So this is a really long-term, extreme outperformance that we've been through over the last 6 months. Investors, I think, are taking the opportunity given to them by that bounce in the 10-year Treasury to potentially move back into some growth names at cheaper valuations, cheaper relative valuations, and shave some exposure to, back into value on cheaper valuations and shave some exposure to growth.
Why now? Because it's not like we haven't seen these levels in rates, before, even the last few months.
It's a relative trade. I mean, there's this incredibly tight correlation that's developed over the last 3 years between financials and the 10-year Treasury yield that has completely driven the financials' relative performance. And when the 10-year Treasury bottomed and so showed some signs of moving off of that low yield, we saw investors rotate right back into financials. It's been a trade that's been off since December. I think the other key here that we might be ignoring is that the ECB meeting was in the middle of last week. And the ECB has had a heavy hand in dictating market outcomes at the sector level because of their impact on the dollar.